Well, the problem is that there's only so much investment you can do that is productive investment, including in infrastructure. So if you have an airport that gets way too many flights, then it makes sense to build a second airport. But if you have an airport that isn't being fully utilized, then there's no reason to build the second airport. And in a lot of cities in China, they've built that second airport, not because they needed it, but because they wanted to keep growth rates high and to keep people employed. Once China reached the level in which most of its infrastructure needs had been met, including for the next several years, assuming different growth rates, then as they continued to invest in infrastructure above that level, an increasing portion of that infrastructure became economically non-viable, non-productive. For example, we have highways in China, beautiful multi-lane highways in China that receive very, very little traffic. And those highways are being extended. So the question is, why are they extending them? The official answer is because they expect traffic to grow over time. But in fact, it's probably because they want to continue employing workers. And I think there's widespread agreement that we've long ago reached that stage in China where much of the investment is not really productive. Yeah, GDP growth is simply, activities that we agree to measure. And there's nothing implicit in the measure of GDP that says that it has to be productive. The reason why most of that activity is productive is because of what we call hard budget constraints. If you keep investing in stuff that's not productive, you will eventually go bankrupt fairly soon. And when you go bankrupt, the debt gets written down. And so whatever you added to GDP then gets subtracted. But in China, you don't have hard budget constraints. You can continue investing in non-productive activity if you're the local government year after year after year after year. So there isn't that mechanism which in most economies forces GDP to represent real growth in the economy. And that's why when we look at the GDP numbers in China, we shouldn't assume that they mean the same thing that GDP numbers in other countries mean. It's because there is no mechanism that prevents you from misallocating investment on a systematic basis year after year. If it's possible to stabilize growth at current levels without an explosive growth in debt, then why haven't they done it? They've been trying for 10 years to do this, to slow down the growth in debt without slowing down the growth in GDP. And they've been completely unsuccessful at it. And that shouldn't be a surprise. Every country that's followed this growth model has run into the same problem of debt. And they've never been able to constrain the growth in debt without a significant reduction in GDP. Sometimes that occurs in the form of a crisis, and sometimes that occurs in the form of stagnation, 1, 2, 3 decades of stagnation. I think a crisis is unlikely in China. I think the second is more likely. But China is following that model that we've seen many times before perfectly. And they've been trying to constrain the growth in debt, and they've been unsuccessful. And there should be no surprise about that anymore. The reason debt is growing so quickly is because you want to keep GDP growth rates above 5 or 6%. And without one, you don't get the other. Well, economists always tell you that liberalizing the economy and letting the market play a stronger role is good for the economy, even though the historical evidence does not suggest that at all. What the historical evidence suggests is that there are conditions under which liberalizing reforms tends to generate more growth. But when a country has got way too much debt, when the financial system is bankrupt or near bankruptcy, liberalizing reforms, the market-oriented reforms, often lead to greater trouble, not less trouble. Because when there is too much debt and the financial system is bankrupt, the incentive structures change dramatically. So when you remove controls, instead of moving in the direction of increasing profitability and productivity, the incentives cause the financial system to move in the direction of managing excessive debt levels. And that's not necessarily the right way you want to go for the economy. When the American savings and loans were all bankrupt in the 1970s, rather than close them down, the government decided to save money by deregulating them and letting them grow their way out of bankruptcy. Well, it didn't happen. What ended up happening was that they got into even deeper trouble, and the cost to the government of closing them down went up by more than 4 times over a decade. So I think that's something that China has to worry about. There are times when deregulating and liberalizing and having the market play a greater role certainly does improve the productivity of the economy. But there are also times when it seems to drive the economy into greater difficulties, and we should at the very least understand which is which. But I would argue that when you have excessive levels of debt, as you do in China, and when the financial system is constrained in all sorts of ways by that debt, you have to be very careful about liberalizing reforms. Whenever we have a global economy, a global environment of slow growth and weak demand and excessive savings, that always spills out into the trade arena, because trade war is really about gaining a larger share of limited global demand. And we are in that kind of position. So, that was a prediction that was pretty easy to make a few years ago, that trade would suffer throughout this period. And I think it'll continue to suffer. The thing is that, and economists are not really supposed to say this in public, but trade war isn't necessarily bad for everybody. For countries with large deficits, diversified economies with large deficits, they often benefit from trade war. It's surplus countries that get terribly hurt from trade war. So if you look, for example, at the end of the 1920s, beginning of the 1930s, the U.S. had the largest surplus in history at the time, and trade war was devastating for the U.S. England entered that period with trade difficulties, with a deficit, and the 1930s weren't that bad for England. They may have even benefited from some of the aspects of trade. So it seems to me that there are very strong reasons for deficit countries to be quite tough on trade. And as long as the economy continues to grow slowly, I don't see any reason to assume that trade tensions will disappear. What I would suggest is that they recognize the extremely difficult position China is economically. I don't think people are aware of how much pressure they're facing on the economy. They're able to keep growth rates above 5 or 6% only because of this explosion in debt. And we all know you can't allow debt to grow forever. At some point you have to constrain it. It's very difficult to do so. But once they do, growth rates will fall quite dramatically. So I think the U.S. needs to understand that China has a very difficult decade ahead of it. And so whatever political requirements or objectives that the U.S. has, and I know it's not going to be a very easy relationship, but they have to make sure they understand the context.